Hey, everybody. Welcome to the Your Home Podcast, where you are home, the number one podcast for first-time home buyers and your home for everything mortgage and real estate. We've got a really exciting show planned for you today. But before we get into that, go ahead and show your support for our channel by hitting that subscribe button and give that like button a tickle too. If we get 1 million likes on this video, Subway is going to bring back the $5 footlong. I'm your host, Gerald Hanson, and today with me is our co-host,
Andrew D'Amato.
Andrew, what do we got for the viewers today? What are we talking about?
So today we're going to be talking about the FHA loan program.
Awesome. That's a big one.
It is. It certainly is. The FHA loan, just to get some basics out there before we really get into it. It's a loan. It's designed for first-time home buyers. It's backed by the Federal Housing Administration. It's got a minimum of a 3.5% down payment, minimum of a 580 credit score. And, really it's one of the biggest, kind of stalwarts of the mortgage industry. You have your conventional loans, you have VA loans for veterans, you have FHA loans. Lots of people utilize these loans to buy their first home. And especially if you have somewhat challenged credit, this is the program for you.
Absolutely. And we so happen to be experts in the FHA program. So this is something that sort of our bread and butter through the years.
Yeah, definitely. I've helped a lot of families buy houses with FHA loans. And really FHA has kind of an interesting history. Basically it was created in Congress in 1934 during the Great Depression.
A government loan.
It is. It is a government loan. Now, it's funny because it's evolved a little bit over the years. Originally it was created, kind of with New Deal legislation, Great Depression, recovery of the economy. But pretty much at this time, the housing industry was, pretty messed up. In 1934, 1 in 10 households owned homes.
Oh, wow.
So there really wasn't much of, a home ownership market at all. It was pretty difficult to buy a home. Most mortgage loan terms at this time were limited to 50% of the property's value, meaning you had to put a 50% down payment.
Okay. A lot has changed.
Quite a lot has changed. So, the biggest thing really with the program though was to help lenders, with them passing it, because what was going on was there was a lot of foreclosures, a lot of people losing jobs, runs on the bank, all that kind of stuff. And so FHA came in and they, created, different programs to help, bolster home ownership in America. And over the years, it's really kind of evolved and developed into, what it is today, which, is a primary route for people to get home ownership who, don't have 20% down,
right,
or 50% down.
Exactly.
But
yeah, that's what it's known for, is being something for first-time home buyers. And we'll get into this a little bit more, but people who maybe don't fit into that, what you call in the business A paper, excellent credit, big down payments, the FHA is designed for those guys.
Yeah, 100%. And so, before we kind of get into it too much more, one really big piece with, the different, what's the difference between a conventional loan and an FHA loan? One of the biggest factors of the program is the idea of mortgage insurance. Mm-hmm. And mortgage insurance is kind of confusing to people. And we have customers ask us this all the time, hey, mortgage insurance, what does that do for me? And the bottom line is it does absolutely nothing for you, aside from the fact that it allows you to use the program that's for lower credit and putting 3.5% down, right? But what mortgage insurance is, conventional has it as well. Like if you put less than 20% down on a conventional loan, you also pay more, they call it private mortgage insurance. It's structured a little bit differently, but on FHA loans, they call it the mortgage insurance premium.
Right.
So FHA, they have this fund, and it's a portion of your monthly payment, and there's also an upfront portion that's financed into the loan. But it's basically this big fund that makes banks want to lend to you with, at lower credit or at, putting less down, right? on a conventional loan, if you put 20% down, you don't pay mortgage insurance. They look at that as you are well qualified, you qualify for conventional, you're putting 20% down. There's no risk to us as the lender. The likelihood you repay that loan is really strong. On FHA, basically as a bank, right, they look at it and they go, well, why would I want to lend? Why would I want to bring 96.5% of the money to somebody with not perfect credit on their first time home purchase? And the reason that they do that is the mortgage insurance premium. Basically, what will happen is the mortgage insurance piece, or even private mortgage insurance on conventional, it's essentially an insurance for the lender that if you're not able to repay the loan, they're going to be insured on losses.
Right. The concept of it seems a little confusing for some people. They're like, oh, you have to pay that mortgage insurance. But there's so many insurances that we have. And mortgage insurance is really no different. So when you simplify it, you've got your health insurance, you've got auto insurance, you've got a bunch of different insurances. You know how that works. In case something bad happens, you're covered. And this is that for the lender. If something bad happens, something bad meaning someone's not able to make their payment and the lender has to go in and go through a foreclosure process, they're covered against, up to a certain amount for losses and damages. So really just simplifying it all, it's just like any other insurance. It's for the lender in case something bad happens. So it's very rare, just like all the other insurance, it's very rare that something bad does happen and that those lenders have to file a claim. But it's there. And one of the good things that we saw I don't know if I'm jumping ahead here, but one of the cool things that we saw was that mortgage insurance fund right now had like 11 times, 10, 11 times more than it needed in that pool. They say, okay, this is the amount that should be sitting in the bank in case of defaults. This is how much we need to have covered. And they had 10, 11 times more than they needed. So the federal government's gone in and they've actually dropped that mortgage insurance premium down. It's going to be happening. We're putting it in play now,
it's
but it's going to
already
be happening. It's going to be officially on loans that close after the 20th of March, 2023. That mortgage insurance, monthly mortgage insurance premium is coming down. So it's getting a little bit cheaper, even cheaper for people on the FHA.
Right. And the other thing with it too is, the mortgage insurance piece, it not only incentivizes lenders to give you, to fund your loan on a mortgage with less than perfect credit and putting a smaller down payment down, it also incentivizes them to give you lower interest rates. So FHA loans actually have lower interest rates than conventional loans.
Right.
But where it kind of equals out a little bit is how that mortgage insurance works. The mortgage insurance on conventional, it is a little bit more favorable than FHA, but now that they've just reduced it by, it used to be 0.85%. Now it's 0.55%. And that's extremely significant because if you think about it, that's more than a quarter of a percent, right? It's 0.3%. So, the amount you pay towards mortgage insurance is on an FHA loan is basically the same as your interest rate.
Yeah.
Right. If you're paying a quarter of a percent higher on your interest rate, it's money that isn't going towards equity. Right.
I always looked at it just adding it into the interest rate. You've got let's say you've got a 6% interest rate and then you've got mortgage insurance that's 0.85%. You've got a 6.85 interest rate. Effectively, that's the way I would sort of simply look at it.
Right. And so now today it would be 6.55.
Right.
So that's, it's, depending on the size of the loan, it's pretty substantial as far as how much it lowers the cost, which is a really great thing for people using this program. It makes it even more competitive for, somebody looking at, do I want, someone in the in-between credit range, do I want to go conventional or do I want to go FHA? This is making the payment even more attractive for this program.
And it's important to emphasize this because historically, I mean, there's a real common misconception about the FHA loan program, and it's sort of gotten a bad rap as, oh, this is for people who are, oh, you have to go FHA. So there's some sort of like negative connotations with the FHA program, when what we can do now is just line up the numbers. Let's just match which payment is going to be cheaper, which is going to have the, less money out of pocket, and just do a very reasonable, logical, let's compare the numbers. Which one's better, the FHA or the conventional loan? And then you make your decision. So rather than putting all this emotion into it, like, oh, that's FHA, that's not for, if I have to go FHA, that's a bad sign.
I mean, at the end of the day, if you, most of the time, if you can go conventional, it really is probably the better route to go. But it really kind of depends a little bit on the credit. And I think we're going to get into that a little bit. FHA, if you're in the 580 to 680 range, FHA is probably going to be your best bet. If you're over 700, more than likely conventional is probably going to be your best bet, but it is a little situational. And especially if you're in that 680 to 700 range, you can almost go either way on it.
Right.
There's a few different ways to look at it,
and there's a lot of changes happening right now. We don't want to get too much in the weeds on some of the loan level pricing adjustments from Fannie and Freddie that are coming down, that are actually, when you take those into consideration, there's people who have historically, the most qualified buyers, perfect credit scores, big down payments, low debt to income ratios. You're actually now seeing that the FHA, even with the mortgage insurance premium on a borrower with a 20% down payment, FHA has actually got a cheaper payment. So that's it's pretty interesting. But the point being, FHA is hot right now.
Yeah.
Hot program.
Now that they lowered the mortgage insurance, that extra 30 basis points, it definitely makes it stand out even more than it used to.
Right.
So, but yeah, I mean, let's get into it. I mean, I think that kind of a big part of what we wanted to go over today is, what goes into an FHA loan, what are some of the differences from other programs, and what somebody, why somebody would want to use an FHA loan, or who could use one. So,
in just starting out in general in qualifying for an FHA loan, it's not much different. Well, not any different at all than any other loan program. You're going to be the lender is going to be analyzing income, assets, and credit. So we'll kind of get into each of those. But basically the process of, as far as income, looking at 2 years of employment history, assets for your down payment, and then checking out your credit. So the specifics for FHA versus other loan programs, FHA is going to be a little bit more lenient. I would definitely say a little bit more generous as far as their guidelines, but from a big picture perspective, pretty much the same thing is going to be, you're going to need the same requirements for an FHA loan that you would anything else. Just FHA is going to give you a little bit more generous look.
Yeah, no, definitely. I mean, all loan programs, I mean, there's pretty much 4 pillars of a loan. It's, income, assets, credit, and then the property itself. So
as far as income, in general, there's lots of different kinds of income, but for the most part, we're talking about wage earners. So that is people who are employed, getting a W-2, whether that's an hourly rate or somebody who's on salary.
Yep.
So as far as income, you're going to be looking for 2 years of employment.
Yep. Yeah, you're gonna have to document the last 2 years of employment history. Now, that doesn't necessarily mean that you have to be at the same job for the last 2 years, but you have to be able to pretty much show what you've been doing for the last 2 years, right? So, if you were working at one job for 1 year and then you switched and worked for another job for the next year, that's totally fine, right? Or even if you're even if you weren't necessarily working the whole time, but like you were in college, like maybe you've been working for a year, but you were in college getting your full-time degree for the year before that would still satisfy the employment history requirement.
And that surprises a lot of people. I was actually talking to a real estate partner yesterday, and he said, oh, well, they don't have 2 years. They just got out of college. I said, hey, show me that diploma. That'll rock for the 2 years of
technically,
employment.
even high school can qualify for part of that 2 years.
Yeah.
And so, granted, most people coming out of high school aren't buying a house, but every once in a while something comes up.
With an FHA loan, you maybe could.
Yeah, it's true.
3.5% down payment.
But yeah, so as far as income goes, right? There's a couple different ways they're going to look at it. If you're a salary employee, that's pretty easy. You're going to go by your annual salary, right? If you're an hourly employee, they're going to look at your past earnings, right? And so more than likely the income calculation is going to be based on like an average. Sometimes they can just take the hourly rate times 40 times 52 weeks a year, divide that by 12. But a lot of times they're going to average that out.
You guys sticking with that math there? Yeah. There's different calculations that we look at, but that's a part of, working with the lender. Basically you come prepared with the documentation, pay stubs, W-2s. If there's no W-2s and it's a college transcript, give that to the lender. They're going to calculate and let you know what they come up with as far as an income figure and what you qualify for. Now, one of the highlights with FHA that definitely differs it from the other programs, and I think this really stands out, especially like I know personally, I used an FHA loan in buying my first house, being someone that works on commission with those other types of income. So there's more than just your base salary, hourly pay. You've got overtime, you've got bonuses, you've got commissions. Most any other program is going to be asking to show a consistent 2-year history on those other types of income. With FHA, there are instances where you would be able to use that income for qualifying after having received it for just 12 months. So that's a real boost for people who maybe they're just getting out of school. Maybe they're just starting as a salesperson in a commission job or overtime, whatever it may be, to be able to use that income because for a lot of people, that could be a significant portion of their income.
Yeah, 100%. Yeah, and they do evaluate overtime and bonus income and, commission income separately from base income. So how that's actually calculated, it kind of depends on what your history of earnings are on that. If you have, it's not just always a straight average, right? They're going to average like the base earnings, then they're going to average the overtime, then they're going to average the bonus. And, definitely having a history of receiving that income is important. So, but
again, with the theme of FHA being more generous in saying, hey, other programs are looking for 24 months. FHA is going to take a look at you if you've just got 12. So something to definitely keep in mind, because again, just like being able to apply for a mortgage out of school without 2 years employment, a lot of people are going to say the same thing. And even other loan officers may not be as familiar with the details of the FHA program and could fumble the ball in qualifying and saying, hey, you've got to have 2 years, because they're just thinking of those conventional guidelines and not giving a look to FHA. So definitely something to keep in mind as one of the, I'd say, major items
that's kind of another thing too that really does come up a fair amount is, people who work in mortgage, like, they're just people too, right? And you might talk to somebody who doesn't calculate your income the way that someone else might. And I know that sounds kind of funny because it's like, well, there's only one way to do math, but believe it or not, there's a lot of ways to do math when calculating someone's income.
Right.
And also like different banks or different lenders, they have what's called overlays. So like some places, like they may, like, even though FHA might allow for a 12-month calculation on overtime, like a bank might say that they are only going to do 24. Right. So it is one of those things. If you talk to a lender and they say that they're not going, that they can't approve you or can't approve you for the amount that you want, it really is a good idea to get a second opinion.
Right. So you mentioned something that I think is a good point that we should touch on is the overlays. So when we're referring to that, it's a guideline overlay. And one of the things with FHA is with their guidelines, pretty extensive. What, about 900, almost 1,000 pages of guidelines?
It's like a 900-page guideline book on how to originate FHA loans. So they are pretty specific on exactly what you can and can't do, and like how to calculate different. I mean, there's lots of different types of income. We just mentioned salary and hourly, but like there's a lot of different types of income.
It's got a lot of different types,
and
it doesn't even hit them all.
Fixed income, border income. I mean, you could go on and on.
Right.
But yeah, I mean, as far as
so I wanted to kind of touch. So there's the 900 pages of guidelines, and these are the standards for FHA. I kind of wanted to go into, if we could, a little bit more on the overlays and how that works, so it makes sense to people. Like, hey, FHA has these rules. FHA says I can get approved with a 3.5% down payment with a 580 credit score. How come everybody's telling me I need a 620?
Well, yeah, that's because you're talking to the wrong people. Or, that comes down to bank overlays. So like, FHA has their base level, it's like 900 pages of guidelines on what, and it basically is the criteria that FHA will insure the loan for the lender, right? So because when you get a loan with FHA, the FHA doesn't give you the loan, right? They don't underwrite the loan. Like the lender gets a license with FHA to underwrite those loans and fund those loans. So the lender, though, still has the option. Like, FHA has their minimum guidelines, but the lender can also say, well, FHA's guidelines say you can go down to 580. We don't want to go below 620.
Right, which is very common.
Yeah,
you'll see a lot of overlays, the most common one being the credit score overlay. So although FHA requires a 580, and even in some cases, if you have a larger down payment, you can go below 580. Specifically, you can go down to a 500 credit score if you have a 10% down payment.
Right.
Now, that's going to be one where you'll find a lot more overlays, but it's less talked about because you typically don't see people looking for that 10% down payment. A lot of the attraction to FHA is the 3.5% down payment. I'd say maybe even more than the lower credit score. So a combination of the factors definitely makes FHA very appealing.
Right. So what we kind of breeze through that, but just to reiterate, so the 580 minimum is just for the 3.5% down payment. You can, according to FHA's guidelines, go down to a 500 credit score if they put 10% down. Now, there's a few extra factors on that working. But we'll probably get into that too. But
back to, and I think this can lead us in. We're taking a little bit of a sidetrack from income assets credit because we're talking about the guidelines. So I think this is a good opportunity. Okay, we've touched on the overlays, most common one being the credit score, and so the lenders are reviewing these programs, according to a combination of the FHA guidelines and any overlays that they have for their particular bank. And then in addition to that, we talked about these are just people. Well, there's some machines involved too. So there is a system that every lender is going to use. For the FHA loan, it's actually a Fannie Mae and Freddie Mac system that you're going to use. It's an automated underwriting system, the AUS, that the loan officer, lender, everybody's going to put all of the criteria, your entire application, all of those factors involved. So your income assets credit is going to be analyzed by this automated underwriting system, and they'll spit back what's called the findings.
Right. It basically grades loans.
Yes.
And it pretty much gives you two grades, right? It gives you a higher grade, they call it approve eligible, or it gives you a lower grade, which is called refer eligible. And approve eligible basically means that, the system has determined that the loan is good, right? Like they don't have to have, there are documentation requirements to substantiate everything that's input into the application, but there's not a whole lot of scrutiny that actually has to go into it. On a refer eligible loan, there's FHA guidelines, like it's actually separate guidelines for
manual.
Right. They call it manual underwriting. Right. Yeah. So if it's refer eligible, there's different kind of criteria. There's a little bit more scrutiny that's put in by the underwriter underwriting the loan to make sure that the loan still meets the requirements.
And this is also really important to know because lenders that will do manual underwriting, is very uncommon. Most lenders, along with that 620 credit score overlay, are going to have another overlay that says we only will work with people who are in that approve eligible automatic approval. They're not going to do the refer manual underwriting. So,
well, that's a big reason why I think a lot of lenders just have an overlay for a 620 credit score, is because typically the likelihood that it's approve eligible is higher if you're over 620. It can be approve eligible in the 580 to 619 credit range, but yeah, a lot of lenders they'll just kind of make a decision. We only do the approve eligible loans. We don't want to mess around with the manual underwriting or the refer eligible programs.
Right. And I think this is a good segue to touch on that, because when it comes to the manual underwriting, a lot of the areas that it's going to differ are going to be on credit. There's a few on assets, but it is going to be on credit. So I guess we'll circle back to assets,
right?
But we'll go from income to credit. So when it comes to credit, on an automatic approved loan, it's basically, that's in essence what it's saying is, hey, this credit's okay. It's an acceptable credit. There's some instances where maybe it could get downgraded, but I don't think we need to go into that.
Right.
It's in the manual underwriting where FHA actually, I believe it's really great that they give you a very specific breakdown of what needs to be, of what criteria you need to meet for a manual underwriting approval. Do we want to get into that? Is this
sure? I mean,
too much?
Well, so before we get into that, I would back it up a little bit as far as the relation between income and credit. So, like the biggest piece with it is what they call the debt to income ratio. This is what determines how much of a loan that you're going to qualify for. And how that works is they take, the income calculation, right? Calculated however FHA says it has to be calculated, right? So your total income on the loan, and then on your credit report, it shows all of your open active trade lines, like everything that you pay per month, your credit cards, student loans, auto loans, installment loans, if you have another mortgage, right? All that stuff factors all that in, and it shows your minimum payments for all these accounts. And so basically you take all of the minimum payments that you already have on your credit and do a ratio with the income called the debt to income ratio, how much you're paying per month compared to how much you make per month. And that calculation is what determines how much of a new loan you can qualify for in a housing payment, right? So, that's the number one driver on how much you can qualify for, is the income in relation to debts you already have. Right. And so if the, a lot of people, it's a big kind of misconception. So, you'll talk to somebody and say they want to qualify for $300,000, and you say you qualify for $150,000, and they go, well, I guess I'll just work on my credit.
Yeah.
Well, okay, but that's probably not, like they're thinking that because they're like, maybe if their credit's higher, they're going to qualify for $150,000 more, and that's just not really the case.
That may be the instance in some other types of loans where essentially if you pass a certain credit score criteria, they don't look at your income and your other debts, and they're not calculating the DTI for you. But every single mortgage program for someone buying a primary residence is going to be looking at your debt to income ratio. So regardless of what your credit score is, it really, it's not going to be a factor either way.
Right. I mean, the credit score dictates what your interest rate is. And yes, having a lower interest rate could help you qualify for a little bit more, but the difference on the rates aren't,
over the long term, it adds up, but in as far as the impact on your monthly payment, it's marginal. The interest rate,
right? I mean, the income is a much bigger factor in how much, which makes sense. I mean, think about it. If you make $4,000 a month versus $10,000 a month, you're going to qualify for more regardless, whatever your credit is.
So that's good. So we talked about the reason for this is we're looking at calculating a debt to income ratio. So we've got your income calculation, and then boom, pull a credit report in. Now we've got your debts. We've got your debt to income ratio. So
now we got an idea of how much of a loan we can do for you, right? So once that's established based on the debt to income ratio, you're going to dive in more into the credit history itself. So if you're somebody who is in the kind of high, the 580 to 640 range, right? There's a higher likelihood that you're going to have, maybe have to deal with the manual underwriting, which is totally fine. But, so they do. So like, on if it comes back at that higher grade, that approve eligible rating, right? Then, the payment history on the credit report really isn't analyzed aside from like major derogatory events like a foreclosure or bankruptcy. There are mandatory waiting timeframes on those. Like if you had a Chapter 7 bankruptcy, you have to wait. It's at least 2 years from the discharge date. If you've had a foreclosure, it's at least 3 years from the discharge date, which actually is another thing that FHA is more lenient on because other programs require longer waiting periods of time than those. But aside from that, right, they're actually going to, if you're refer eligible, the manual underwriting, right, they're going to actually look at, they're really going to scrutinize the last 2 years of your payment history. So like if it's a refer eligible rating, you cannot have any 30-day lates on installment loans, like auto loans, or I guess technically student loans are considered installment loans.
Student loans, personal loans, basically anything aside from a credit card.
Right. Pretty much, yeah. Anything besides from revolving a credit card, right? And a housing payment, also your rental, like which includes your rental history, which isn't even on the credit, but you cannot have any lates in the last 12 months.
No late payments on personal loans, student loans, or car loans in the last 12 months if you fall into that manual underwriting category. Right. So always good to know where you're at, how long it's been. If you are somebody that had some of those late payments, how long it's been since you had them.
Right. And then they look at the last 12 to 24 months, and they will not allow you to have more than 2 30-day lates in the last 12 to 24 months on housing or installment payments. On credit cards, they consider, like unsatisfactory credit to be if you've had more than, you can't have any 90-day lates on credit card payments in the last 12 months. And you can't have more than 3 60-day lates on any credit cards in the last 12 months.
But 12 to 24 months? If it was more than a year ago on a credit card, FHA doesn't.
They're okay with it.
They're okay with it.
It's kind of crazy.
Yeah, pretty relaxed.
They
must know something about credit cards.
Just in general with credit history, they do, even just how it impacts your score. It is kind of ranked, mortgage first, right? If you miss a mortgage payment,
if you miss your
credit's going to go down huge, right? You miss a mortgage payment, your credit's going to go down huge. That's like number one, right? Number two, they look at installment loans. You miss an installment loan payment, that's like the second, your credit's going to go down a ton. You miss a credit card payment, your score's going to still go down, but it's not going to go down as much as if you miss an installment or a mortgage. So it is all kind of related a little bit in that way, which kind of makes sense. If you're somebody who's in a bad financial situation, and the money's running out, what's the first thing you're going to miss a payment on? Probably the credit cards, right? You're not going to just miss your mortgage payment first and then make sure you pay your $400 tab to Capital One on time, right? You're going to if you're in trouble, you're going to miss your credit cards first, then you're going to miss your car payment, and then you're going to miss your house.
So FHA is pretty relaxed on the credit cards because after 12 months, they're not looking at it. Another item is on an automatic approved loan, they're just going to analyze your credit. When you go to the manual underwriting, the lender is actually going to require that you verify that you have made your rent payment on time. So typically that's going to be contacting the landlord or leasing company for most people who are renting and having them fill out a form and verify that you have not been more than 30 days late on your rent. So that's one of the things that is going to be pretty big separator from the manual underwriting to the automatic approval is verifying that rent.
And also too, with the late payments themselves, when we talk about a late payment, it's a 30-day late payment, meaning it's not that, okay, the payment was due on the 1st and you paid it on the 12th. It's the payment was due on the 1st and it's now, your payment was due on April 1st and it's now May 2nd and you just made the payment that was due on April 1st. It's more than 30 days late.
So they're wanting to verify that you have not been 30 days late on your rent. And one of the other things that we'll hear oftentimes, and there are some lenders that have overlays on this, is collection accounts. And can you have a collection account and get approved for a mortgage? Do you have to pay off all of your collections? This is I'd say one of the more common questions that we get, and sort of misconceptions around getting approved for a mortgage.
Yeah. So, once again, kind of credit in general, right? You have your on-time payment history for your open accounts. But then there are also collection accounts and also what they call charge-offs, which are a little bit different than collection accounts, but similar. And these are accounts that basically you did not make your payments on, you never made the payments on. Now they sent that debt to a collection agency and you have a collection account on your credit report. So with FHA, they have, you can close on loans with having collection accounts on FHA loans, and you can even close. Even on conventional loans, you can do that too. But
some lenders may have an overlay where they'll sort of cap you, or someone may have told you in the past, if you've spoken to a loan officer, hey, you have to pay off those collections. Again, know who you're speaking with. Those may be actually just specific to their bank or their company, their requirements. But FHA will allow you to get approved with collections. There is not any limit as far as what amount of collections you have. It's not good. Obviously, not good for you, not good for your credit, not good for the person that you owe the money to. But FHA will look past that. Now, over a balance of $2,000 in open collections, FHA is going to require that the lender take 5% of that outstanding balance and assess that towards your debt to income ratio. Right. So even though you're not paying on those collection accounts, FHA is going to take a payment and pop that in there. And meaning your ability to repay the mortgage, they're going to take a factor on those collections and assess that in your debt to income ratio.
Right. So like, for instance, how that math works out, if you add a $2,000 collection, they're going to count a $100 monthly payment for that account, even if you're not paying it, but factor that into your debt to income ratio. And another area where they do something similar for that is for student loans. So for student loans, even if you're not in repayment on them, lenders do have to consider a factor for how much you will have to repay. With student loans, there's a lot of flexibility on, especially lately with COVID forbearance. Almost nobody's been paying their student loan.
We were expecting billions of dollars in student loan forgiveness. That's a common theme. Different administrations, they'll use that to, get people's attentions. Hey, we're going to forgive student loans. So student loan forgiveness, and there's a lot of people, like you said, that aren't paying. But
or this is a graduated repayment plan where you're paying, they base it on your income and you have a lower job now and it's going to go up more.
$10 on a $100,000 student loan.
Right. So in that case, we're not, the bank's not going to consider the $10 payment on $100,000 in debt. They're going to do a different calculation to factor into your debt to income ratio, even if you might not be paying it. So, which
has also, FHA's gotten a bit more generous on that as well. Now, you have to understand, most of those student loans are federal student loans. This is a federal loan program. So, the government guys are sort of looking out for each other. Sally Mae doesn't want FHA, loaning more. Well, they're not doing the loan, but, insuring more loans when somebody's not paying on their student loans. So FHA is going to take 0.5% on your student loan. So if you do have $100,000 in student loans, you're looking at assessing a $500 monthly payment. That's if you're not making any payments. If you're making a payment on it that's more than $500, then we'll just take whatever that payment is and assess that towards your monthly liabilities.
I think there's even a couple different ways that you can kind of get around using the 0.5% calculation. But for the most part, that's kind of
for the most part, people can swing it on the 0.5%.
Yeah. And that's all, like you were saying, that's something else that FHA has gotten a lot better with too. When we started, it was 1%. Yeah. And there was no wiggle room on it. You just had to take 1%. Right. Or whatever payment was on the credit report if it was higher than 1%. And that eliminated a lot of people.
Yeah. That was tough on folks.
Yeah. But
that has changed. And so another thing where people say, that's a very common question. can you get a mortgage with student loans? Just like there's some information out there that if you have student loans, you can't get a mortgage, and that simply is not the case. This is exactly how it works. So,
right.
And
it gets considered, but yeah, you can definitely get a loan with outstanding student loans. One thing though that, like you were saying, with it being a federal program, that there's not a lot of leniency on is if you have delinquent federal debt, like if you have like a tax lien, or if your student loans are in collection and they're federal student loans, like if you have federal student loans that are in collection, like there's no way you're getting an FHA loan unless you get those out of collection.
Right.
But yeah, being a federal loan program, they are a little bit sensitive to you having other outstanding federal debt, which once again, kind of makes sense.
So anything else on credit? I feel like we've covered more than enough as far as the credit goes.
The credit and the income, they're kind of, very closely related to determining how much you're going to qualify for.
Yeah.
But it's one of those things. Okay. So, all right. So all that checks out and you can qualify for the amount you're looking for. And what's the next piece?
Down payment. 3.5% down payment for FHA. That's great. Super low payment. And you would think, hey, you've either got the money, or you don't, but there's a little bit of nuance there with the money, because with basically any mortgage program, the lender is going to want to source, and they're going to want to know where that money's coming from. So you're going to be required.
Why that is?
Why is that?
So the reason that you have to source cash deposits on bank statements for mortgage loans is actually from the Patriot Act.
Interesting.
Yeah, it's about money laundering, because real estate's one of the easiest ways to launder money, so they say. So, or I shouldn't say the easiest way to launder money, but it's
fairly common.
It's one of the ways that some nefarious individuals may try to clean their money.
So the lender is going to look to source the funds. Now, sourcing the funds just in general, meaning, hey, show me the money, show that you have it in your bank account, and then also analyzing the deposits in that account to know where they came from. So if you've got that mattress money, the coffee can in the pantry that you've been squirreling away loose change in, that's not going to fly, having that deposited into your bank right before you go and get your mortgage. So that would be something that you'd want to figure out, how to make sure that you have your money in the bank account. In general, would you say 2 to 3 months, prior to going to get your mortgage?
Right. So, as far as documenting assets goes, right? There's this is actually another thing that AUS, and whether you're the approve eligible or the manual underwriting, right? Some of the documentation requirements are a little different. So if it's approve eligible, they're really only going to need 1 month's bank statement. If it's the manual underwriting, they're going to ask you for 2 or 3 bank statements. So they just have to document it a little more thoroughly. Now, with the bank statements, right? So this is something just on the planning side of you being, wanting to be a homeowner. That's important to think about, is where is all my money?
Yeah.
Right. Because, because there's lots of documentation that gets brought into with applying for a loan. So if you kind of have your ducks in a row, it will make your loan process much easier. Right. So like if you have all of your money for the down payment in one bank account 2 months before you close on a house, like it's going to be much easier than if you have 3 or 4 different bank accounts that you're going to then transfer a bunch of money into, transfer all the money into one account or however you're going to do it. Because basically you have to document that you're going to have the funds, that you have the funds for closing before an underwriter is going to clear the loan.
So what are some acceptable sources for the money for the down payment?
Yeah. So
does it have to just be, hey, I've got the money in the bank right now, or are there other ways that someone can come up with the money?
Well, yeah, so there's a lot of different ways you can come up with the funds. Obviously you can use anything that you already have in your checking account or savings account. You can get a gift from a family member. You can sell an asset. You could pull from like a 401k or retirement account. There's also certain down payment assistance programs that work in conjunction with FHA. We're probably not going to, I don't think we're getting into the down payment assistance
That'll be
too
a
much.
whole other episode. A very exciting one at that.
That'll be a whole separate thing. But there are some programs out there that you can utilize for that. But, so yeah, I mean, but pretty much what they're going to do is they're going to get the bank statements, right? And then if there's any large or unusual cash deposits, they're going to ask where those came from. So like, for instance, if you have, if you need $10,000 for your down payment and you send in the bank statements, you have $12,000 in there, but there's there's a deposit for $5,000 in cash. They're going to say, where did that come from? And it doesn't matter what the answer is. If it was cash, it's not acceptable. So there's just there's not going to be any paper trail. If you have a deposit in the account and they say, where does it come from? And you say, here, I have this check that was written to me by my grandma. My grandma gave me a check for $5,000. Well, in that instance, you could say, okay, now we've got this documented and this would be considered a gift. So grandma gets to sign a nice letter that says, this is a gift to, Johnny boy, my grandson, for him to buy his house. And he doesn't have to pay me back. Right. And then also with the gift, though, we have to show that money coming out of grandma's account.
Yeah.
So if you're getting getting it,
like we said, it seems very simple. You've got the money in your account or not, but there's a little bit more to it just on documenting everything. And one of the big ones being on those bank statements, the lender's going to need all pages of the bank statements. Including that last page, number 5 of 5. That's an entirely blank page. The lender wants all pages of those bank statements. Now, along with assets, aside from the down payment, you're going to have closing costs. So what are closing costs? Well, closing costs are going to be made up of lender fees. So that could be a processing, underwriting fee from the lender. There's going to be other third-party charges, like for a title company and settlement agent, for them to make sure that there's no funky stuff going on, with the property's history. And then they're also going to be doing the settlement for you. And then you've got, what do you got? Taxes, baby.
Oh, so, yeah. Uncle Sam's coming
You've got all kinds of taxes, whether that be a transfer tax, and then, of course, your property taxes and homeowners insurance that you're going to have to prepay. So there's this combination of all these items that are going to make up closing costs. Now, the great thing with FHA is even with a 3.5% down payment, FHA allows for the seller to pay all of the closing. Well, the seller to pay up to 6% of the sale price towards your closing costs as the buyer. So it's a possibility for you to get into a home without any of your own money. You could get a gift from a family member for the down payment and get all of your closing costs covered by the seller, because in most instances, that 6% is going to be more than enough. Would you agree, to cover all your closing costs? Yeah.
Closing costs are something that definitely varies state to state, like by a lot.
Yeah.
We
go from North Carolina to Pennsylvania. What happened to the closing costs?
Yeah, they doubled.
Polar opposites.
Right.
Yeah.
Yeah. North Carolina is one of the probably one of the most friendly states as far as closing costs go. There's plenty of other ones along with North Carolina that are similar, but like Pennsylvania, closing costs are high. Transfer taxes are high. A transfer tax is a tax specifically on the transfer of real estate. And in Pennsylvania, in some places, it's almost like 2% of the sales price.
Wow.
Pennsylvania is also it can also depend on the county. Like, state to state, county to county thing, it shifts
There's
a fair
closing
amount.
Costs, people. Be ready for them.
Right. But FHA does allow for 6% to be covered. Now, if you're on a conventional loan and you're putting less than 10% down, you can only get 3% covered by the seller. So that is something that FHA is definitely more favorable on, as far as how you can, potentially negotiate a contract for yourself to have some of that stuff covered for you.
Is a sleeper program right now, especially with that reduced mortgage insurance premium or monthly mortgage insurance. When you now say, okay, I can go in and just with a 3.5% down, I can get all of those closing costs covered. It's going to really put you ahead as far as not needing a ton of cash out of your own pocket to get into a home. And that, we know, is the number one barrier for people to get into their first home is going to be that cash investment. So this is really important. And on those conventional programs, you're only able to get 3%, and that may cover it. It may not. With 6%, talk to a lender. There's a lot of things you can do. You can actually get a little bit. 9
times out of 10, you're not even going to need 6%. I mean, the one thing I will say as far as the closing cost goes is like, I mean, that's the ideal scenario. And if that's what you need, then that's what you have to shop for when you're negotiating. And any, your realtor is going to play a big factor on that too, as far as having that negotiated into your contract.
It's not guaranteed. It's not like FHA says the seller has to pay 6% for your closing costs.
I mean, realistically, like if you're shopping for a home and in a competitive market, it can be tougher to get the closing costs covered, because if you think about it this way, right, you're a seller and you get 3 offers and 2 of them don't ask them for $10,000 in closing costs and yours does. Well, yours is probably going to, not come in as the best offer, right?
It's important that your real estate agent and your loan officer lender are in good communication, that your team is working together, so that, because your real estate agent's going to be working with you to make sure that they're finding you properties in the right neighborhood that meet your criteria as far as bedrooms, bathrooms, all that good stuff. And then your lender is going to be focused on the number. So it's really important. And we make a point to be in good communication, making sure that we're providing those numbers. If you are somebody that absolutely needs to get those closing costs covered, we're going to lay it down with the real estate agent and say, hey, we've got to figure out a way that we can structure this offer to get the seller to pay those closing costs. So maybe you've got a house that's listed at a certain price and we want to get a few extra % covered on closing costs. We could even go in and offer a little bit more than the asking price on the home to then basically incorporate and structure that deal so it makes sense for everybody.
Right.
And you're going to be able to get the house and not have to come up with all this money out of pocket, because that money doesn't grow on trees.
No.
It doesn't just fall out of the sky.
Fortunately, it does not just fall out. Well, I guess if you're in Congress, it can kind of fall out of the sky. They make a lot of money, but
the government.
Yeah, they pass a lot of money. But anyway.
So now closing costs. Did you have something else you wanted to say on closing costs?
I didn't have something else I want to say on closing costs. I was going to kind of circle back to assets in general. So we were kind of talking about, checking or savings account. You already touched on, gift from a family member. One thing with the gift on a family member, FHA does have kind of strict rules on it being like on who is a family member. A cousin is not a family member. And this is also another area where some lenders have overlays, like they will only allow for gifts from family members, but FHA's guidelines actually allow for gifts from people who have, I forget what the phrase is, like a closely documented relationship. It can technically be a friend. I think in some instances it can even be an employer. If it's from an employer, you got to be careful because it can't be a pay advance. That's technically a loan. But there are, a couple other sources aside from family members, but you definitely want to talk with your lender closely about that. As far as like selling an asset, so that would be a situation where like, hey, I own a car, like outright, I don't have a loan on it, and I want to sell this car, and then I want to, I'm going to sell this car for $5,000, then I'm going to put it in the bank account. Well, you got to be a little careful how you sell the car, right? Because the lender is going to ask you for proof of ownership, which should be easy, like a copy of the title or even like your insurance policy that you had on the car before you sold it, to prove that it was your asset to sell. And then also they're going to ask for a bill of sale for who you sold it to, right? So like if you sold the car for $5,000 to, Joe Smith, right? You write up a little bill of sale that says I sold, this model car to him on this date for $5,000, and then you deposit that $5,000 in the account, right? Now, the one thing you want to be careful of is when you do things like gifts and also, selling assets, is that you want to make sure that whenever you deposit it, you deposit the same exact amount that you were given, right? You don't, because it can complicate things like, okay, so you sold the car for $5,000 to Joe Smith. That's what the bill of sale says. And then you went to the bank with another $400 that you just had laying around and you deposited $5,400, right? Underwriters like when everything lines up exactly. So it's really, really good for you to, if you sell something or if you get a gift, it's the same exact amount, no
easiest
extra,
way to
no
make
less.
that happen is to make sure that you have the paper, meaning that you are getting a check, or that if you're just doing a wire transfer, obviously there's no way to screw that up. So if the money's being electronically transferred, it's definitely going to be the exact amount.
Right.
So that's pretty cool. You can obviously just your regular checking and savings. You can get a gift from a family member. So that means you're not bringing any of your own money.
Yeah.
And, sell an asset. Did you want to talk about anything specific on being able to withdraw from a retirement account?
So one other thing with assets that we haven't even really talked about is month's reserves. In addition to documenting the funds for closing, if you can document extra funds, right, they call them month's reserves. So like if the mortgage payment you're applying for is $2,000 a month, and your cash to close is $10,000, right? The total amount you have to do at closing is $10,000, your mortgage payment's $2,000, and you have $12,000 in the bank account, right? That means that you have enough money for closing the $10,000, and then you have $2,000 extra, which would be 1 month's reserve. So having documented month's reserves is something that can be very beneficial to impacting whether your loan is a manually underwritten loan or whether it comes back at that higher grade.
Right.
Or also, too, if it's a manually underwritten loan, it requires that you have at least a month's reserve. So
yes.
Being able to document extra assets is really great, and that's one thing that retirement accounts are very useful for, is being able to document extra assets that you might not be using. Or if you are going to use your retirement account, basically you need to be able to confirm. You pretty much need to confirm with your employer as far as like how, not necessarily your employer, but whoever your 401k provider is, or retirement account provider is, can I withdraw for a home purchase? If it's something like, if you have like a pension, that's, or a deferred compensation plan, 9 times out of 10, that's not something you're going to be able to pull from for a home purchase or use for reserves, primarily because you're only able to access those funds if you quit your job or you retire. In order to use something as reserves on an account, it has to be something that you can withdraw from. So like a 401k or an IRA, they usually have terms of withdrawal for hardship or for, I forget what the term is, but basically it's special uses, which are like buying a home or having a child, or college, I think is sometimes one of them.
If you're a first-time home buyer,
Hardship.
you can take money out of your 401k.
Right. Exactly. Yeah. So, in that case, a lot of times there's 2 options on pulling money from your 401k. It's either taking a withdrawal or taking a loan against it. A lot of times they kind of push you, or their primary option is to take a loan against your own funds, because it helps you on the tax side of things. If you take an early withdrawal from a retirement account, you're going to have to pay taxes on that. So, if you pull out $10,000, you might only get $7,500, right? Or something like that. But
so consult with whoever's managing that asset account to look at what your options are and decide what's best for you. But it is a great way.
Yeah, it's a really great source of funds for it. And I mean, really too, obviously, it's not necessarily great to encourage people to, pull from their retirement account for other expenses. But
when it comes to real estate, absolutely.
Right. When it comes to real estate, it's a little bit different because that is a positive, pulling from your retirement account is, your retirement account is for retirement, for your future, right? But when you are buying a house, it's almost like its own little mini retirement account, because you're going to get appreciation and you're going to build equity, and it's an asset you're going to have for a long time, and that you can then pull from for retirement later if you need to. So
the number one contributor to wealth in this country, believe it or not, is not people's 401ks. It's real estate. It's their equity in real estate. So if that's an option for you and you have an opportunity to withdraw from that 401k, it's a great option. So, and I'm glad that you led that from the retirement account into the reserves, because we look at the reserves, and yes, there are requirements for reserves. If it's a manual underwritten loan, you have to have 1 month reserve. There may be instances where you may have to have 3 months reserves. And then having the extra reserves can help you go from a manual underwritten loan to an automatic approved loan. But aside from just the guidelines and the requirements, you should have some money saved up in the bank. Yeah. The reserves are there for, in case something comes up. You do not want to be going to closing.
And things will come up. Things will come up when you buy a house. Something will happen. The water heater will break.
You do not want to
when that happens, you don't know, but something will happen.
Yeah. When you go to closing, you're going to cut the check for your down payment. You don't want to turn around and have no money in the bank account and then be running out, accumulating balances on your credit cards or whatever it may be. You want to have some extra funds there in the bank, and the more, the better. So I really can't say enough yes, it may not be required for you to have those reserves, but, a part of our job, as mortgage brokers, yes, we're going to do the loan for you based on the guidelines, but we're also going to advise you on, hey, what's the most common sense way to approach things? And
moving costs money. Furnishing a new house costs money. You want to have some wiggle room when you're making this big transition into, your first step into home ownership.
Yeah. And you want to have some savings, for things that come up down the road, whatever it may be. I would start with a minimum. You should really be looking at a minimum of 3 to 6 months reserves. So, I would encourage everybody, because I know that the people who are watching this, you are someone who wants to better yourself. You are someone who wants to, provide a better future for yourself and your family, financially, with putting, a roof of your own over you and your family's head. So that is going to be the biggest things, is going to be the reserve. So I'm glad that we can wrap things up with talking about, take a look at your budget. Take a look at what you're spending your money on and figure out a way to put some money aside into an account and leave it there and not touch it. And that's aside from if you're doing a 401k and you're getting the match. Make sure you've got that emergency fund account. Make sure you've got, that minimum conservative at 3 to 6 months. You really want to get more than that. Is it going to be required for you to get a mortgage? No. Are we going to turn you down if you don't have 6 months reserves? Absolutely not. But the best thing for you is going to be, just so you can sleep well at night, is knowing that you have those savings. So that, on top of buying a house and getting into your first home, knowing that you've got, 3-6 months reserves minimum set aside, is going to be a great thing for you. Yeah, so
100%.
I believe that we've covered it all here. We've gone really deep dive into the FHA program. And so I'd like to thank everybody for, we're going to wrap things up here. Did you have anything else you wanted to add?
Yeah. I mean, as far as other things I'll add, just overall, the FHA program is a really great program. There's a lot of things that you can do with it. It does come with a couple extra strings attached on some of the stuff with the property, which we really didn't even get into, but they're very minor, and they're not too tough to work around.
Right.
I mean, a house has to be move-in ready for the most part. All the utilities got to be on and functioning when they go and do the appraisal. Sometimes you do get some conditions on an appraisal that you might not get with like a conventional loan, but it's very minor stuff. It's usually when that does happen, it's usually very easy to be fixed by the seller. A lot of times it's like chipped paint or rotted wood frames, or sometimes even handrails on stairs. Yeah. But really, like, that part of it isn't quite as important as the qualifying of it. And I think that was really our main point here, was, going through and breaking down to people what goes into qualifying for an FHA loan. Is this a good program to qualify for, and what it entails? So
right.
I think we've gone pretty deep on it here, and there's a million different scenarios, but yeah, that's why you want to talk with your lender, and you want to know what questions you need to ask.
Excellent. So, hey, thank you everybody for sticking with us, and I hope that you were entertained, and that you were engaged, and that you learned something here about the FHA program. Obviously, you're somebody looking at getting into your first home. Hope that this was some value that you got out of this conversation here. So again, we appreciate your support. Go ahead, smash that subscribe button for everybody watching on YouTube, and give that like button a tickle. 1 million likes, and Subway's going to bring back the $5 footlong. Really excited about that, guys. Thank you, and we'll see you next time.
See ya.